The story from the project, innocent black man. Let me be clear. Damn, man. The story from the project, innocent black man.
What up, YouTube? Welcome back to the Small Account Challenge. Today is day number 115. Of course, you know, I said I would take some time off, try to regather myself. The account still stands at about $2,000. And yeah, like I said, we ain't getting no trades today because I really want to get back to the basics. But anyway, I did say while I'm taking this time off, I wanted to put together some videos for people who've been asking about it. So today is video number 1. This one is going to be how to day trade options. 7 questions you need to get answered. So here we go. Let's get into it. All right, so I'm gonna try to keep these videos somewhat tight because there's a lot of information on the internet, on YouTube, that you can get a lot of information from. So I'm trying to give you information that I think is vital for your success when it comes to day trading options. Because there's a lot that you're not going to need just to day trade options, and I'm gonna give you what I think you need to keep moving forward, especially with a small account. All right, cool. So 7 questions I'm going to answer in this video. So I think it's important that you watch the whole video. All right, number 1 is especially if you have a small account. So how to day trade options if you have a small account. When I say small account, I'm talking about the account that we started with, the mustard seed traders. People started with $100, $300, $200, something around there. I don't mean 5,000 small account. I'm talking about when your account is really, really small, as most people's accounts are. So, alright, so because I noticed that the market is stacked against us. There's a lot of manipulation in the market, and now that I'm sitting on the side right now, I can actually see it right in front of me. So it's really, really stacked against you. So you need to place the odds in your favor as much as possible in this probabilistic environment. So, question number 1: what stock tickers should you trade? Well, if you have a small account, and for this explanation in this video, I'm gonna go with, let's say, somebody at an account balance of, let's say, $200 maybe, or $250, something like that. And what tickers should you trade? I'm gonna give you 2 tickers, and the reason why I'm giving you these 2 tickers, the first one is one you see I trade almost every day, which is SPY, SPY, and the second one is the QQQ. SPY is representation of the S&P 500, and the QQQs kind of mimic the NASDAQ. Now, the reason why I say these 2 is because when your account is small, you don't have a lot of room for expensive option contracts. So you need a lot of expiration dates, and SPY and the Qs have a lot of expiration dates. I'm gonna show you a little screenshot here, or a little video here. You can see it there. So options, the way they work is, the more time you place on your side, the more expensive the premium becomes. But if we're day trading, we don't need that much time. So that's one thing that's to our favor. We don't need a lot of time. So one day from the expiration date is all you need, in my personal opinion. So if I was trading today, and today is March 31st, I'm taking contracts that expire tomorrow. All I need is one day. And the reason why I choose one day is because I don't need theta, which I explained in another video some time ago. I don't need theta attacking my contract heavily if the stock goes against me. I need enough cushion for the stock to go in my favor. So remember, the tickers you want to trade is SPY and QQQ because they offer a lot of expiration, and options contract costs more the more time you have. But since we're day trading, we're trading weekly, but for the most part, we're trading dailies for the most part. And all we need is one day. Now, if it happens to be on a Friday, you can try to trade 0 days to expiration, or you can trade Monday. I don't like 0 unless you are sharp with your entries. Because 0, if it goes against you, boy, that bad boy adds up fast. But at least if you choose Monday, when on a Friday's trading day, did that buffer. Once again, it kind of keeps theta at bay. So that's the first question. Those are the tickers I think you should trade if you have a small account. SPY and the QQQs, because they offer a lot of expiration dates. Question number 2. Oh, I already answered question number 2, which was which expiration date should you choose? That's, like I said, it's 1 day expiration from the current trading day. You can choose 2 days because they're not that expensive. But like I said, the reason why I'm telling you 1 day and let me go with question number 3. Which strike prices should you select? Now, this is a tricky one. This is how, when my account was very small, this is how I selected strike prices. Remember, option contracts have 3 levels. There is the at the money, which is the strike price that is currently close to the actual stock price at that moment. So if the stock price is, let's say for example, SPY right now is 556. If I go into the options chain and I look for a strike price that's 556, that strike price is at the money because SPY right now is 556 and the strike price is 556. We can't choose that contract. It'd be too expensive for our $250 contract. So we don't need that one. We don't need in the money. Why? Because in the money, that means, for an example, if I'm looking at a call meaning strike price is call meaning I'm looking for the stock to go up. So let's say for an example, I choose a strike price that is 555. That means the strike price is already in the money because SPY going up has already passed 555 and right now it stands at 556. It's already in the money, meaning on its way up it passed 555. Now it's in, the strike price was hit and now it's going further in the money, which is 556. We don't want that one because that's more expensive than at the money contracts. You don't want those. The ones you want with a small account are out the money contracts, especially if you have a small account. Now, the reason why I'm saying small, out the money, because the further you are out the money from the current stock price, the cheaper the contract is. But this also has a caveat. The caveat to that is this: the further you are out at the money, the slower the contract moves either direction. So the way you're going to choose this, this is how I've chosen it when the account was very small. When the market opens up, I look for out the money contracts, but I look for the ones that are moving as the price action is moving. Because you can see that when you watch the option chain, you can see how much a contract is moving, how valuable it's becoming or how less valuable it's becoming depending on the price action. But another thing you can look at is your account balance. For an example, for this explanation, we said our account balance was $250. I would look for a contract at about half that, for about $125. That's in one that is moving. That way, I have enough, maybe a little bit lower, maybe $100. I have enough to buy 2 contracts. I don't buy it immediately though. What I'll do is I'll buy the first contract. If it's going in my favor, I might can add another one because my account balance is $250. I only spent $100. I can add another $100 in there, or it's going to be a little bit more expensive because the contract is going in my favor. I have just enough to add another one before it gets too expensive. Also, this works in your favor. Say you find a contract for $100, the strike price for $100, and the stock goes against you, and now it's down to about $90, $95, or $85. If you want to bring down your cost basis, there's enough money in your account balance to add one more contract to bring down the cost basis in hopes that the stock reverses and go back in your direction. So now you have 2 contracts with a lower cost basis, and now the stock is in your favor, and now you're green. But that can also go against you. If it goes against you, now you have 2 contracts going against you, and you need to get out of that before it's too late. So that's how I choose my strike prices. Once again, just in case you missed it, I'm looking for out the money, not at the money and not in the money. I'm looking for out the money contracts, and I'm basing it on my account balance. I'm looking for half my account balance or a little bit lower. And I'm looking for one that are moving as the price action is moving when the market opens up at 9:30. That was question number 3. All right. Question number 4. Okay. How much profit to take when you get into the trade? Of course, you know I've been stressing 2 and 3%. So with a small account, getting 2%, 3% is pretty fast. There's no need to hold. Why are we holding? Why are we not holding? Because we have a small account and we don't want the stock to go against us. Because remember, if it goes against us fast, that's less buying power tomorrow. So we need to get our 2 and 3% and be out the door. You can go for more percent, but I've noticed, especially in this market, if you get greedy, your green quickly turn to red. As you can see, my last 2 trading days, I was up, then went down, so I had to take a chill pill. So that's question number 4, which is 1, 2, 3. Yeah, question number 4: how much profit to take? I say 2 and 3%. If that's too much for you, go with 1% until you get used to the getting that 2%. That's not a lot. That's not a lot. Something that's $4 or $5. I know what some people are going to say. That's chump change. Well, we got a small account. What you expect? You can't expect to get a 15, 20, 40 bucks out of that account unless the stock is running or we're in a bull market and things are running pretty fast. Because if you hold and it goes against you, like I said, your account is a lot smaller, and we already started with a small account and we cannot risk it. Or like they said, what you could do is have some cash on the side that you have just for re-upping your account in the event, like I said, the discipline is not there. Okay, 1, 2, 3, 4. Question number 5. And I've gotten this a lot. Mike, yes, I'm not disciplined enough to take profits or stop myself out when the stock goes in my favor or goes against me. Do you have any solutions for that? Alright, you've heard me stress it enough on this channel, but I'm going to say it for the ones, particularly for this video. Use the guardrails. What? Training wheels? No, the guardrails. What are the guardrails? The guardrails is a slang term that traders use in our community and others around the world. They use to describe something called an OCO order. An OCO order, which is the acronym for one cancels the other. What that simply means is when you place your trade, you're also placing an order to take the profit and an order to stop the loss at the same time. So, for an example, you get into the trade, you get failed. You're going to see 2 other orders surrounding your order. One is take profit and one is stop loss. And what you do, you can actually set the percentage of the take profit and the stop loss. But I already told you what percentage you should have it at. It should be at 3 or 4%. 2 and 3% going up, or 2 and 3% going down. Or you can make it 3 and 6% going up and leave it at 2 and 3% going down. This is to protect you against the stock going against you and to protect you against greed. Now this is, I'm telling you right now, this is not always easy, but this is the best solution I've found to help traders who are undisciplined, like myself sometimes. If the stock goes in your favor and it hits the take profit, it stops you out with your money and you walk away with the bag. If it goes against you, it hits the stop loss, it stops you out with the loss versus it being a bigger loss. Because what we tend to do, and this is what I've learned, and I feel like this is a little bit of manipulation in the market. Like, for an example, why do so many traders fail? If there are a lot of people trading the market, but more people fail than succeed, that means there is some sort of probability against most people. Because if more people are succeeding, then the market would be leaning towards success stories. But most people are failing, which let me know that the market is stacked against us, and I think it's stacked against us in the way where it's really hard to win. if you're not disciplined. And like I said, this is why, like I said, use the guardrails or OCO orders. Your brokers, I know good brokers normally have the ability to set up OCO orders. You go into the order field or the order function in your account, look up OCO, one cancel the order, or they may call it additional orders or something like that. Anyway, so that's how you protect against that. Now that's, like I said, it's not always easy, because you can place the order, see the stock going against you, about to stop you out, but because you're emotional, you cancel the order. So now the OCO order is gone, and the stock goes further and further and further and further, and now you're hoping that it goes back in your favor. But now what was only a $5 or $10 loss is now $25, $35, $45, $55, $105 loss, and all you had to do was leave the guardrails to stop that. But I know this is not easy to do, but that helps. It helps a lot. Okay, question number, let me see. I think we got question number 6. Okay, how do I enter a trade, Mike? Okay, this is how I do it. You don't have to do it this way, because every trader has their own strategy. This is how I do it. I look for 2 things when I enter a trade. 2 ways. I look for the reversal, because stocks only have 2 moves. Really 3, but really 2 moves. 2 strong moves. Stocks are going to go up and they're going to go down. I remember asking a former trader, if a stock is going up really fast, is it strong or weak? This trader said strong. I said absolutely not, because the further away it moves from its entry, or from the 200 or from the moving average, the weaker it becomes. Why? Because people will start to take profit, because stocks never run straight up. You can see it here. And I can pull the chart up here. You can see it on the camera here. We got one green candle going up, the next candle red. Doji candle, red, green, green, red, green, green, red. Then they never just go straight up. So that's one way to enter the reversal, meaning as you see it going up, it's getting weak, you take the opposite position. Or the same thing, as it's going down, you see it getting weak, take the opposite position and get on it. But once again, you gotta have your stop losses in place. Why? Because all the time, the stock market is irrational. What normally is supposed to happen sometimes in the market doesn't happen. You can see something like this. Look at this strong candle here. We ran up. The next candle probably should be a red candle. Once you get another strong green candle, that's the purpose of a stop loss. Just in case what normally don't happen, what normally doesn't happen happens. I mean, what normally, yeah. Anyway, like I was saying, so the reversal, and another way is the second way is at key levels. This is probably the better way, key levels, because more traders are watching this. Now, what is a key level? I made a video about key levels before, but just to give you a quick short about key levels, here we go. Key levels are simply where the stock is going up in one direction and then come down to the next level. You can find these a little bit better on the daily chart. You can see a little bit better on the daily chart. You can see key levels. You can see it here. You can see it here. It's going up. Key level, come back down. Going up, key level there, come back down. It goes up and reverses. Those become key levels, where the stock reverses position, going from one direction to the next. You can chart those. Now, there are some minor key levels within that. You can also chart as well on lower time frame, but on the daily, those become key levels. And that's another way to trade. You wait for a stock to hit a key level, and when it hits the key level, you jump in for the reverse. Or in the same thing, as it's coming down to a key level, you get in as it's going the other direction. That's another way to trade, to enter a trade at key levels or for the reversal. Now, the reversal strategy is very good when there's a lot of momentum in the market. When the market is kind of choppy like it is now, it's a lot more tougher to do that. So be mindful of that. And on the last question, question number 7, which is, Mike, how do I practice my strategy without risking real money? 2 ways. You can manually paper trade. I did this years ago back in 2017. Manually, what you do is this. You get out a notebook and a pad, a pad and a pencil, and you look at the premium you want to get into, and you mark that price down. When the market opens up, you ask yourself, at what price are you going to get in? When that price hits, you write that price down. You write the price down. Now, if the stock goes against you, you have to write where you would get out. And if the pot goes in your favor, you have to write where you get out. That's how you manually paper trade. You decide where you're getting out and where you're getting in at. Manually, you have to write the price down. This is how you practice your entries. Like for an example, I'm looking at a option chain, looking at a strike price. The strike price could be $1.50. You say, okay, cool. This is going down. If this goes to 130, I'm jumping in. You write down 130. That's my entry. All right, cool. My take profit is 150. If it goes to 150, if the stock goes to 150, you were right about your entry. If it goes to 120, 110, 115, 110, 190, you know you were wrong about your entry. That's one way to practice paper trading. That's the old school way. Now the other way, which is a little bit more advanced now, is using a simulator. Good brokers normally have a function in their system where you can actually trade on their system using fake money, but you can set your account to the level that you want it to be at. Like for an example, since you're going to be trading with $250, set the account to $250, and then you actually trade the strategy that you're working on in that account using their simulator. It's not real money, but you get to practice your strategy. Now the downside to paper trading, and many traders will attest to this, you don't feel the same when you make money or when you lose money. That's the difference. And because what makes trading hard is the emotional side to me. And you have to remove the emotions. And this is like I said, you have the guardrails. But that's what makes trading hard to me personally, is the emotional side. Paper trading, there's no emotion. If you make $5,000, you're okay, but you're not really happy like that because you know it's not real money. If you lose $10,000, you're tight. It's not went against you, but don't affect me. I'm good to go. Was my money, right? So that's the only downside to that. So anyway, those are the 7 questions I think you need to be aware of if you're going to be day trading options. I hope this video helps the ones who asked for it. Anyway, we'll be back at this tomorrow. I'm not sure we're getting into the game yet, but if the video comes out, you'll know I traded in terms of, because I'll talk about the recap. If not, I'll continue to keep getting into some more training for the folks who asked about it. Anyway, y'all, I will see you guys back at this tomorrow. All right, y'all. Peace.